Welcome, everyone, to the May 2026 edition of ClearVista Financial Perspectives. I'm Mark Trice, and I appreciate you taking a few moments to join me today for our monthly market update webinar. With everything going on in the world today, it's easy to feel a little bit unsettled when it comes to the markets and the economy. And my hope today is that what we have to say will help put your mind at ease. We'll walk through what it means for you, your investments, your financial plan, and your peace of mind. On today's program, we're going to go over the market recap. We've seen some unprecedented, I would say probably one of the most unprecedented recoveries of a drawdown that we have seen in recent times. And we'll talk about what that means for the portfolio and everything. If you'd like to interact with us, you can text us at 254-282-0495. That's 254-282-0495. Or you can email us at info@clearvistafinancial.com. We'll do our best to maybe address some of those during the program. If we don't get to your question, we certainly will reply within 24 hours after the program airs. Okay, let's jump right in to the market recap. Really impressive month of April. The S&P was up 10.4%. It's up about 4.5% to 5% for the year to date. The NASDAQ in the month of April was up 15.7%. The Russell 2000 was up 12.3%. Now, long-term treasuries, we did see the long end of the bond curve, which we'll show here in just a moment. We did see yields rise. That could be because of a continuing conflict in the Iranian war, and it also could be because of higher oil prices and so forth. So we're not surprised that we saw long-term yields tick up a little bit in the month of April. The moderate index did not do nearly as well. That's a 60-40 type index, 60% stocks, 40% bonds. And you see it kind of lagged a little bit, mainly because of the impact on bond rates and their values. Now, what was unprecedented about this, and I haven't gone back to go back past the last couple of decades, but it was in the span of back in March, the markets lost as much as 10%. Certainly, the S&P was down about 9 at one point. The NASDAQ was down over 10.5 to 11%. And we not only saw all that gain back, we saw some more. And to have a recovery really happen within a couple of weeks, to have that quick of a recovery is that doesn't happen much. Now, we'll talk later on about drawdowns in the market. Drawdowns are not to be avoided or not unavoidable. They're going to happen. It is a reality in the market every year, year in, year out. And a lot of people tend to panic when they happen, but it is a natural part of a normal market cycle. And what we don't typically see is this quick as we did in April, a very, very fast recovery from that 9 to 10% drawdown. That was unprecedented. So there's some caveats here we'll talk about as we go throughout the program, but this was highly unusual. The drawdown, very usual, very typical. We usually see 1 to 2 of those 9 to 10% drawdowns or more every year. But the recovery was highly unusual this time. So here's our disclosures. There will be a quiz at the end of the program today. If you can recite those, you will receive a bonus prize yet to be named. But we'll move on here. Let's talk about volatility. There certainly was volatility in April. We saw that come down. I looked today, the VIX, the S&P 500 volatility index was down around 17% or 17. That's down from 30 right after the Iranian conflict or war happened. The yellow arrow here shows where we are headed into May. May tends to be a little bit less volatile market anyway. It seems like the markets are ignoring the Iran war right now. Yes, the price of oil does impact the market some, but we don't seem very concerned about it. The discussion has come back to, oh my goodness, is there a bubble in artificial intelligence? And we'll talk more about that in a moment. But the big thing was we got to experience this last month. The Federal Reserve, Chairman Powell had his last Federal Reserve meeting as chair. And the main concerns there were, inflation, which was up in the month of March, rising oil prices, and so forth. But the thing that was characteristic here, or most notable in this meeting, was there were more Fed presidents that dissented from whether or not the Federal Reserve should lower interest rates. And so that just shows there's not a lot of an agreement between all the Federal Reserve presidents about the direction of future monetary policy like this. So the markets are now kind of getting ready and shifting towards the new Fed chairman once he's approved, which will be Kevin Warsh, and whether those leadership changes could change the tone of the Fed. What's interesting here is that Chairman Powell, Jerome Powell, is going to stay on the board after he steps down as chair. Now, this is not all that common to have a retiring chair stay on the Federal Reserve Board, and that could create some future conflicts, maybe some mixed messaging, especially if you can imagine, usually the Fed presidents are allowed to speak to the public, or maybe they give a speech to a university or some type of organization. And then you have Kevin Warsh, who may be most likely be the chair. And then the next day you have Jerome Powell, the former chair, maybe giving a different message. It's going to be interesting to see how they manage that. I think here, though, the message was if energy prices stabilize and economic growth slows later this year, maybe some modest cuts could return to the conversation. So let's jump over here to the next slide. And this is really looking at the prediction for the number of cuts that might be expected. And basically, we're not seeing much positive certainty on whether or not the Fed will cut interest rates here. There's too much ambiguity in the Iran conflict, whether that's going to get solved. There's, of course, the price of oil, rising gas prices, and so forth. And these oil prices may stay higher than investors are accustomed to over the last several years. And the broader economy looks kind of mixed. There's growth is slowing, but it's not collapsing. Corporate earnings are still very strong, and AI investment remains supportive as well. The key message here for investors is to not radically change anything long term, because based on these short-term geopolitical headlines and stuff. And so once the tensions fade from the Iran front, the headlines are likely going to be shift back towards interest rates, the economy, et cetera. So let's give you a little bit of an economic update. First, I want to show up the yield curve. Now, I put both of these on there for a reason. The blue line is the Treasury yield curve as of May the 1st or April 30th. The purple line there, or the fuchsia line there, whatever color that is the yield curve right before the conflict in Iran started. Now you can see we've had the yield curve increase. So rates across the board are higher. Most notably is in that 10-year Treasury yield, which really impacts a lot of your borrowing cost, especially for auto loans, mortgages, etc. This is substantially higher than it was before we invaded Iran. So that's something we'll keep an eye on. We'll see once the oil prices go down, and once the Iran conflict is settled, we'll see hopefully that blue line come back down to where it was. So let's talk about the GDP and how the economy is growing. The economy is still growing, okay? But it remains moderate rather than strong. The business investment, especially around AI and technology infrastructure, continues to be the major driver for economic growth. One good thing is consumer spending. We're out there spending, and that remains positive. But um, outside of all the AI investment, the underlying economic growth looks noticeably softer. There are trade weaknesses, slower construction activity, and overall GDP growth in the quarter. And so inflation within the GDP report remained elevated. We're going to talk about the CPI here on the next slide. But it's interesting because here in Texas, you would think that high oil prices would be beneficial. And I was listening to one of the trade councils for the oil and gas trade, and really in Texas, the oil prices between $70 and $90 a barrel is where it's consistent enough that oil developers and people drilling for oil and gas can make a profit. Anything lower than that, it's hard to make money. Anything higher than that, the demand drops quite a bit. So it's quite the balancing act here. So let's look at CPI. So the Consumer Price Index. The CPI rose 0.9% in March. That's up 3.3% year over year. So inflation is rising just a little bit. The good news, food prices, which we all talk about in the news, of price of eggs and things, that remain unchanged in March. The core CPI rose about 0.2% during the month of March. So inflation is creeping back in, but we would expect that, especially when you look at the rising gas prices. Okay. All right. What about the producer index? This is a little bit different. It actually rose 0.5% in March. That's really well below what was expected, 1.1%. That's about 4% year over year. So that's really driven a lot by energy prices. And in this case, for the PPI, the food prices actually declined. So we're going to have to continue to watch this over time. What about employment? Employment in March, we haven't gotten the April data yet. The March jobs data was a lot stronger than we expected, and that helped ease some of those recession concerns that we saw in February. Most of the rebound came from the temporary February weaknesses came, including some of the weather disruptions we had in February. But a lot of that remains positive. Private sector hiring remains positive. The labor momentum tends to be slowing. Fewer people are participating in the labor force. I think we need to have a whole webinar on participation in the labor force. We are seeing over the last decade or so, we're seeing a tremendous number of young labor age men not participating in the workforce. I mean, they're purposely staying at home and playing video games. No joke. We need to have a whole seminar on that. We'll talk about that sometime. So wage growth still kind of cooling a little bit, but it's not keeping pace with the rising inflation pressures. So we probably need to be preparing for a slower new normal in job growth. So a lot of these things are kind of leading to me to believe, I'm going back to really the Obama administration where we redefined what it meant to have full employment and redefined what it meant to have strong economic growth. And it really, during that time, we began to position the United States as a weaker entity, a weaker country. And it seems like we're kind of in that period like we were from '08 to the mid 2000 teens and so forth. So industrial production, industrial activity weakened in March. A lot of that had to do with the geopolitical stuff, not being access to a lot of the shipping things that were coming out of the Gulf. Technology and AI related manufacturing continue to be bright spots, so that's good. Mining activity softened, but higher oil prices could support stronger energy production in the months ahead. So we'll continue to watch this to see what might be an impact on the economy. Like I said, nothing is cratering. Nothing is coming down very quickly. Things are softening, but then we see mixed signals about spending and things of that nature. So income growth is strong. We're still seeing the inflation be a little bit hotter than necessary, and that accelerated quite sharply in March. Let's jump existing home sales. Let's go to home housing starts. The March housing data was stronger than expected, but we expect some of the rebound was likely to the recovery of the weather-related stuff. We had some big cold snaps in February, and both single family and apartment construction improved, showing builders they're still trying to meet this long-term demand. We mentioned that mortgage rates went up, creeped up quite a bit since the Iran conflict. And so we'll have to continue to see if those higher interest rates have a longer term effect on housing starts, housing sales, and et cetera. Okay, durable goods. We showed some manufacturing activity, showed some renewed strength in the month of March. That's always good. And the business demand for manufacturing remains healthy, especially as we mentioned before, technology, machinery, and AI related investments. Okay, what does all this mean for you? Let's just have a quick conversation about this. We've had a lot of ambiguity in the market, lots of mixed signals. Inflation creeps up. That's scary. Have a war in Iran. That's scary. But what's really driven the market and kept it going, being stable or going up is earnings. Now, earnings are important. That's really the fundamentals of what drives the market. Are companies that we are investing in making money? And so far after the first quarter, we've had about over 60 or so percent of the S&P 500 companies reporting their quarterly results. Year over year revenue growth on average is over 10%. And the earnings growth on average is over 27%. And so that's positive. And that's why the stock market continues to grow and accelerate the way it has been. And we talked earlier about the drawdown that we had in February and early March. That's perfectly normal. And I have a chart that I was going to put in here that showed you 25 of the past drawdowns, but it was really messy and complicated. Wasn't good for television or YouTube viewing and stuff like that. So, all in all, earnings are drawing the growth here. So those corrections that we've had, that one we had in February and March, a broad market correction more severe than the one we just had, it is inevitable. All right, it's going to happen. You don't know when or what will cause it, and neither do we. And in attempts to avoid it, will do much more damage than we can by just embracing it. We used to be into and managing portfolios through technical analysis, and we found that the approach that we're using with our portfolios now is much more robust and gets us away from potentially market timing. We don't like to market time. No one does, because no one's really successful at it. I think the conversation that we come back down to now is, are we in this artificial intelligence bubble? Is there a bubble there? Well, we really can't predict a bubble until it bursts. That's the challenge. We can go back and look at the technology bubble, the internet bubble that we had in the late 90s, early 2000s. We didn't know that was a bubble until it burst. I can name the day. It's March the 9th, 2000 was when the bubble started bursting. And we won't know that until it's over. So we may not be in an AI bubble right now. I don't know. It's hard to predict. But I do know is the key of who survived the 2000 tech bubble that we had in the early 2000s, the people that were well diversified and not over concentrated into technology tended to fare better in times of strong market growth and more tough times of market decline. So the key there is, let's make sure that we're limiting our exposure to the AI story. Should we participate? Maybe so. And I think my portfolio includes some of the AI stuff, but we need to make sure it's well diversified. And when that bad does come to the AI story, it will likely be in a situation where there's opportunity on a selective basis to take advantage of the bad. So I just say that because what's really driving the market growth is the fact that we're continuing to have strong earnings. And when we have strong earnings, the market typically goes up. What are the solutions? Well, you need to talk to your advisor. If you haven't talked to your advisor about what else is going on, you are an ostrich and your head is buried in the sand. You need to talk to your financial professionals to get some sense of what's going on with your portfolio. And folks, as I always say, don't let your decisions be driven by the headlines. The headlines are not written based in financial fundamentals. They're just not. They're designed to get you to click or to get you to turn the channel to listen to the story. Talk to your professionals, talk to your advisors. If you don't have one or you're not able to talk to your advisor, give us a call. We'd be happy to walk you off the ledge and help you, give you some peace about your portfolio. You do want to stay informed, but we have a long-term investment horizon. Investing is not about timing the markets and making a quick buck. That's not what we do. That's not what professional wealth managers should do. We should be looking at the long-term picture for your portfolio and how it impacts and achieves your goals. So, what about retirement? I recommend you give us a call. There's so many different options that are available to you if you're still participating in a 401k. We are able to give you some advice on picking the best funds there. Your plan may have a self-directed brokerage account that's available to you to allow your advisor to manage that portfolio completely different than the plan menu. Most 401k plans have maybe a dozen to 20 different mutual funds in them, and trying to pick which ones are right for you is very hard. You do want to seek some professional advice. Give us a call. As I've said, our best way to reach us is actually at our email, info@clearvistafinancial.com, or you can give us a call at 800-491-4508. As always, talk to your professionals, educate yourself. Don't rely on ChatGPT. ChatGPT is good about framing conversations. It's not very smart yet about giving you the exact answer. Always talk to your professionals about these things. Don't make investment decisions on ChatGPT or any other AI tool. I think we need to add that to every webinar to remind ourselves that investment advice does not come well-rounded, except when it's from a professional that can look at all aspects of your personal financial situation. So you can give us a call. As I said here's our numbers on the screen. You can contact us. Best to send us an email or call us at the 800 number. We will be back next month to talk to you about what happened in the month of May. And, folks, if you really want just someone to look at your portfolio, look at your financial plan, and see if you're on track, we welcome to do that. That's something we offer a complimentary consultation for you if you're not a client already, and we welcome the chance to visit with you. We can do that virtually, in person, in one of our offices, or on the Zoom or the phone call. Folks, thank you so much for participating today. I know this is a lot of information. A lot of things have been changing in the last 30 days. If you have any additional questions, just shoot us an email, give us a call. And until next time, this has been ClearVista Financial Perspectives. Have a great day.
Securities offered through Cambridge Investment Research Incorporated, a broker-dealer, member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and ClearVista Financial are not affiliated. Discussions in the show should not be construed as recommendations or investment advice. Always consult with your investment professional before making important investment decisions.